Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. Well, it's Friday. It's that time again where we're going to have a look at what's been happening in currency markets over the week and explore some of the interesting thematics and event risks that we're going to be looking at in the new week coming through. And also some of the trading dynamics such as implied volatility, risk reversals, positioning that can give us a clear sense about the event risks that we need to be managing throughout the week. Our risk management styles, and of course, things like achieving correct position sizing based on implied volatility and the expected move that we're going to be seeing. That's what I look at very closely, not necessarily looking backwards at some of the realised vol measures, but also what's been going forward. So straight to the boards, let's have a look at what's been happening, give us a sense about the momentum taking us into the new week, where it's all sterling buyers at the moment. The sterling's been the strong currency there. If you have a look at this chart here, which I've put together, you can see the level of net futures positions that are being held by non-commercial accounts. We look at those very closely to give us an understanding about what the speculative community are doing. This is from last week's data, so it's a little bit stale, and of course this is from last Tuesday as well, and of course sterling has had a decent move since that time. We've actually had cable moving up about 90 basis points on the 87 basis points on the week. Actually, if you really wanted to generate that profit throughout the week, obviously being long sterling yen's been the trade of the week in G10, up 1.8%. If you want to mix it up a little bit and go on the crosses, then sterling Brazilian real has been the place to be. It's had a very, very strong move. Obviously, spreads are a little bit more punchy on that cross, but sterling yen doing very nicely in that situation. The idea that you're seeing rhetoric from the Irish Prime Minister saying a pathway to a possible deal is in the mix. People obviously sterling shorts and those Brexit hedges don't like that situation too much, especially when we're seeing somewhat more constructive views around the Irish border, which of course has been the major sticking point there. The Northern Irish Secretary, Julian Smith, talking about a potential deal as well. Sterling shorts have been a little bit scared off in that situation. So have we seen with those with gilt longs as well. 10-year gilts in the UK up 12 basis points on Thursday. There's a VAR shock to the system straight there. Staying in the bond market, I think it's really interesting to see the influence that the German 10-year is having on the euro. You can see, again, that the euro's had a bit of a gain on the week. Certainly sterling euro against the crosses is looking somewhat more compelling, although euro sterling's had a decent fall. What we are looking at is what's happening in the Bund market. Bunds are looking a little bit more constructive there. You can see here the regression that we've been seeing since the October bull run. That effectively looks at the line of best fit, and what we're seeing is 2 standard deviations. Price or yield is above that level now. If the buyers are going to step in, they're going to step in now. Otherwise, we're going to see further upside. And if we do see yield through this kind of this recent pivot, negative 43.5 basis points, that is going to attract euro inflows, or should we say euro shorts are going to cover. You can see there is a bit of a tidy correlation between euro dollar and what's happening in German Bunds at the moment. So if we're going to see a further constructive move to the upside in German Bunds, I think it's going to be something that we are watching. Last week I talked about looking at inflation expectations both in the US and also in Europe. I believe that continues to be a driver of euro. We saw euro inflation, 5-year swaps, moving up from around 1% up to about 116. I think that's really feeding into the German Bund market, causing sellers. It's causing upside in euro as well. So as we go through the new week, watching that very, very closely. The event risk in terms of Eurozone, what's going to drive that sell-off? Well, I think it's going to be more of a global flavour, not necessarily what's happening in the data in Europe, where we're watching ZEW confidence numbers. We're also watching those inflation numbers coming out of Europe. But I think it's probably going to be driven by more of a sell-off in what's happening in the UK, what's happening in the US Treasury complex, given the US and China relations and the feel is still going to be very much the epicenter of everyone's world. If you have a look at what's happening there on emerging market currencies, the zlotys working very nicely. The PLN up 0.5% against the US dollar. Obviously on the downside, there's big selling coming through in Turkish lira. It's expensive to be short Turkish lira because obviously you're paying a lot of carry on that situation. But for me, being core short Turkish lira still seems a very positive situation. We've got to pay the carry on that on the swaps. But, I think being short in this situation now where Donald Trump is threatening economic Armageddon on the Turkish economy, it really suggests to me that the risk is that we are going to see a further weakening of the Turkish lira. I think on the top of that pile, you've got some strength coming in the renminbi. I talked last week about the dollar CNH being that proxy of what's happening in the US-China trade negotiations, and that continues to be the case. But I think what's really interesting is after the bearish outside day reversal that we saw on Thursday, the close correlation that you've got there with the Australian dollar. If you want to be looking to trade downside in dollar CNH, you're probably better off trading Aussie to the upside because the spreads are tighter, and you can see there's a very strong correlation. So it really doesn't matter too much about what's happening in the Australian economy. It's really more about using the Australian dollar and to an extent the Kiwi dollar as a proxy of that trade negotiations and paying a little bit less than dollar CNH. But if dollar CNH is going lower this week, you're going to see Australian dollar moving to the upside. Now, in terms of economic data and event risk there in Australia, well, you know, you've got, what have we got for the week? We've got jobs numbers really going to be the driver. We've got the Westpac leading index. I think that's going to be probably cause a bit of a pop in the market if we do see that coming out. But rarely causes too much of a stir. It's all about jobs there. The jobs number expected to come out at 5.3%, 18,500 jobs coming through there. Obviously, it's a bit of a lottery. Predicting that's very, very difficult indeed. But I would be looking much more closely at what's happening in China trade. If we do see something that suggests on the 15th, when this 250 billion tariff on 250 billion kicks in, if we see something that suggests that's going to be pushed back, yeah, you're going to see upside in the Aussie dollar because you're going to see downside in dollar CNH. So that's a really big date for my diary there. What's happening on the 15th? Will these tariff kick in? If it's delayed, then you could see some upside in the China proxies. I think that's going to be really interesting to watch. We've obviously got what's happening in Brexit. Everyone's eyes are watching what's happening in the EU summit. Will we get some sort of resolution being put in place? On the 19th, will we see Article 50 being extended? What does that mean? Are we likely to get a deal? Or are we likely to see a referendum, or are we likely to see a general election? My base case is that we're still probably more likely to see a general election, but the market is warming up to the idea that we could see some sort of deal playing through, and you don't want to necessarily short if you see that playing through. So obviously something that we're watching there as well. In the US, well, we've got retail sales. I think it's going to be the big one on Tuesday. The market's expecting that to be up 0.3%. That's going to be a really, really influential situation, especially the retail control group. We watch as that. The retail control group is the element of goods that go into the GDP calculation. Again, the market's looking for 0.3%. But have a look at charts we've got here. Have a look at the range of Fed speakers throughout this week. That's going to be a really influential one. For crypto heads out there, have a listen to Lael Brainard. She's going to be speaking midweek, talking in the crypto conference there. So that could be quite interesting for people who are following cryptocurrencies. See if she's got any kind of warming suggestions about the development going there. I've also I think the big one's going to be on Richard Clarida, the vice chair. He speaks on Friday. Very, very influential. Richard Clarida is seen as the architect behind Fed policy. Now, if you have a look at here, have a look at the chart here in terms of what rate cut expectations. You can see on the third column the probability of a rate cut or a move there. Again, you know, you've got the Fed now priced at 78%. So Richard Clarida going to be very influential. If he doesn't like that pricing, if he thinks that there's a collective move for rates to be on hold, he will guide markets lower in that situation. Of course, yeah, if he comes out with fairly accommodative rhetoric, the market's going to say that pricing seems fair. Of course, we're watching what's happening in those trade negotiations. If that does seem there's a much better feel, that I think that pricing could come down to about 60, maybe even 50%. But Richard Clarida's comments very, very key. We've obviously got what's happening in the RBA. You can see there's a 46% chance of a rate cut there. The RBN said it's a done deal that we get a rate cut coming through in November. Again, you know, something what we're seeing in the Bank of Japan, the market on the 31st of October still fully expecting the deposit rate to be taken down there as well. So that meeting very, very much live. On the far column, you can see what's pricing across the swaps curve there in terms of the extent of rate easing. The market's still looking for that as well. But I think that retail sales number, very, very key. China, I think there's going to be a lot of data coming out there. You've got trade balance numbers coming out on Monday. The market's expecting exports to be down 2.9%, imports down 6%. That may cause a little bit of a reaction depending on the outcome, of course. But markets find this one very, very difficult to read. Quite often the actual level of surplus will be wildly different from what markets are looking for or what analysts are looking for. On Wednesday, we get CPI numbers. The market's looking for 2.9% there. And on Thursday, this is the biggie. You've got industrial production numbers. Remember, this has been very, very weak. The market's expecting a snapback in industrial production numbers up to 4.9%, so up 50 basis points from the previous reading. We get fixed asset investment, retail sales, and the third quarter GDP on that read there. The market's looking for 6.1%. So obviously, depending on the outcome there, you could see some moves in some of the China proxies. Again, we've got our eye firmly on what's happening in dollar CNH there as well. In Canada, you've got CPI numbers coming out midweek as well. So for me, there's really, in terms of event risk there, we've obviously watched what's happening in Brexit negotiations and the EU summit. We've got obviously what's happening in the trade talks. But in terms of data-wise, I think you've got a lot of data in China, and also retail sales for me are the big ones there as well. Now, in terms of how we're set up on terms of risk reversals, have a look at this back to this chart here. This looks at the skew of put versus call volatility, 25 delta. So the market's saying that on these strikes, there's a 25% chance of being in the money. You can see there, I think, as well, what's happening in cable 1 week risk reversals, that the skew now 1.35. So the market's been massive buyers of call volatility, slightly out of the money. They're saying that on balance, the upside is far greater than what we're seeing on downside. So people have been either protecting themselves or speculating, using 25 delta call volatility there, and they've been big buyers relative to put volatility. So I think that's really interesting now. You've got that sitting at the 96th percentile of the 12-month range. The market is very, very bullish on the pound, looking at the options market over the coming week. They've certainly been big buyers there. We've also seen that in dollar yen as well. If you have a look at 1 week risk reversals, there's been big buying of 1 week call volatility in that as well. We've seen that trading up to the 108 handle in terms of $8. So we've got our eyes firmly on what's happening in trade, but also when that risk reversals are telling us that they see upside against the yen there. So the market looking pretty good. Go into the implied volatility structures, and if you look on the far left, you can see 5-day ATRs, the average true range has also been pretty low outside of the pound crosses, but certainly, the volatility in FX market is still pretty subdued. You can see here in 1 week at the money implied volatility. Have a look at again where we saw what was happening in risk reversals in cable, but in sterling against the US dollar in terms of 1 week at the money implied volatility 13%. That's where the market is expecting their big explosive move, but it's still only the 64th percentile. To give you an understanding, if you put that into the Black-Scholes formula and understand what's happening with the range, you can see that the market with a vol of 13.5% is expecting a 206-point move. That puts a range throughout next week of 126.42, 122.30. Obviously, if you don't like volatility, if you're not looking for that, if you don't like being involved in that big move, then certainly stay away from the pound. But if you like those explosive moves and you can handle the drawdown, you can handle that situation, you want to be looking very closely at what's happening in the pound. But do be aware that you're trading against headlines. That can be quite problematic for a lot of traders. And also euro sterling as well. You can see the expected move there, 124 points. Going down to dollar CAD, we talked about having CPI numbers there, but the market there looking with an implied volatility of 4.99%. That's the 17th percentile. So implied volatility in dollar CAD very low. In euro dollar still very low, 29th percentile. But it's all about Aussie yen and the sterling crosses at the moment. The market is saying here that they're expecting some fairly punchy moves. That for me means keeping your position size very low in the pound, and also being able to react real time and keeping your eyes firmly on the news flow as well. So what we're watching throughout the week, there's going to be a lot of news flow, still very focused on what's happening in trade. All eyes on what's happening to pound. We saw that reverberating, not just in a position adjustment, but the market getting pretty excited in the risk reversals, and what we're seeing in implied volatility. Definitely something to watch there.